Hi guys, and welcome to another episode of Investing Made. In this video we are going to talk about the different types of investors that there are in the markets and why it is crucial to understand which kind of investor you are going to be, because one of the keys of investing is being consistent with your strategy. So let's get started. So before starting the video, I want to remind you that this channel is everything about personal finances, saving money and investing. So if you haven't subscribed yet, consider subscribing because you don't want to miss the next episodes. Okay, so the first two categories that we have are the bigger categories, and is passive investing and active investing. And the big difference between them is the amount of time that you are willing to put in managing your portfolio and the amount of research that you are willing to do into the different companies that you are willing to buy. So it is actually quite important that you define which one you are, also in terms of managing your emotions. So normally it is easier to manage your emotions and take less decisions if you are doing the passive investing route, just because you just buy, for example, the whole index, or you are just always contributing to a managed fund. So like that, you don't have much of the, like, oh my god, this stock is falling apart, so I'm just gonna sell. And normally if you are kind of like freaking out by these swings of the market, it is really important that you stay out of the active investing, and you can maybe focus more on having, for example, a mutual fund where they can manage that for you and they can reassure you like, oh, don't worry, these kind of hiccups in the market are normal. So it is really important precisely to define which kind of investor you are in, so active or passive. Now for passive investing, there are basically two big ways of doing passive investing. One of them is having a mutual fund. So mutual funds are normally managed by some people, and they decide basically which stocks should be in the fund and which stocks should be sold, and they will also give you some sort of like consultations, so you'll be able to ask them like, how do you think the market is going, and maybe whenever you are freaking out, they will relax you and help you like stay in the market. And that's maybe a service that is important for some people. Now the other way is index fund investing, and basically what the index fund investing does, and is normally cheaper because of this, is it is just tracking what the market is. So for example, the S&P 500, or for example the Australian market index, they will just mimic exactly what the market is doing, and that is normally done by robots like computers. So that's why they are way cheaper. So it depends a lot in your personality, I think, choosing between these two. If you need the counseling thing and the fact that they are kind of managing and staying on top of it, I will just go with mutual funds. But if you are more calm and you're willing to accept that sometimes the market will fall and go up, I'll just go index funds. There's also the fact that through history, lots of the times the index funds have actually outperformed the mutual funds. So you are paying less for it, and you are probably getting more gains than most of the mutual funds. Now within the active investors, we are going to talk about 4 different types. Now the first one is dividend investors, and dividend investors basically are always looking for that extra income that dividend paying companies give you. So every quarter or every 6 months they are going to give you some dividends, and that's basically what they are after. It is important though to consider that for this strategy you still need to do the whole analysis for a company. Sometimes the dividends are not safe, maybe because the company is in trouble or they have a lot of debt. Sometimes they are even getting debt to be able to pay the dividend. So you have to be really careful with this kind of investing. And basically, if you are within active investors, you will always need to determine, okay, is the company that I'm getting good? Is it like meeting certain risk criteria? And it is really key that you understand like a company within itself to be able to determine if it is a good buy or a bad buy. Now the second type of active investor that we are discussing is called value investing, and this kind of investing is normally promoted by Warren Buffett, Peter Lynch, probably the greatest investors in history. And the idea is that the key of investing is actually understanding the businesses that you are buying. And yes, a lot of people just forget that a stock is not just like a lottery ticket, it's actually a piece of a business. And the key is understanding, okay, what type of business am I getting? doing, what is the current financial position that they are in, what are the future plans for this company. So you really need to go into deep into understanding what is the company that you are getting, and also if you are getting it at a fair price or if you are getting like a great value, because the idea is that the price is actually really different from what the value is. So you really want to buy companies that you understand and that are undervalued, so they are selling cheaper than what they are actually worth. So of course, with any kind of investing, there's a risk involved, but the idea is minimizing this by really understanding the company that you are buying. And if you actually decide to do active investing strategy, I will definitely think this is probably the best strategy out of all, because it can really get you into going deep into the investments that you own and just treat them as businesses and become a business owner of probably whatever company you decide to buy. Another key element of this kind of strategy is that it's really long term, and what Warren Buffett says, for example, is don't hold something for 10 minutes if you are not willing to keep it for 10 years. Now, the last two types of investing, I kind of struggle to actually call them types of investing, just because I truly believe that if you are investing, you should be on it for the long term. But these kind of strategies are more like day trading and using technical analysis to determine what to buy and what to sell. And the idea of this strategy is that they basically keep track of different trends on the prices of the stocks and determine if it will go up or low in a given day. Sometimes even within minutes they will do several trades. And one of the disadvantages of this is that, first of all, you are just kind of relying on mathematics and determining like what the price is going to do. And a lot of the great investors, they literally say, I have not a clue what is going to happen in the market within one day, not even within 6 months. So it's actually important to determine more what is the actual business that you are buying. Okay guys, that was pretty much everything for this video. I really hope you enjoyed it, and if you did, be sure to give it a like. Leave down below in the comments what kind of investor do you actually are, and also consider subscribing if you haven't, because we will go into deeper analysis of the different types of investing and also how to do that here in Australia. I personally think that is key to determine the kind of investor that you want to be and that you stick to it if it is working for you, because sometimes in the markets, like when you have a big dip, a lot of people hesitate and go out, and that's definitely what brings like the lowest performance that you can get. So it is really important that you believe in the strategy that you are working on, and that you put the time, for example, if it is an active investing strategy, or if you are really going to focus in the passive investing, you have to be really consistent with it and be careful and understand that sometimes the market will have hiccups, so it is important to go over them. So anyway guys, I'll see you in the next one, and consider subscribing so you don't miss the next episodes. Bye bye.